those rate changes. And right now we're in this very volatile market. I mean, we've settled for right now. So looking at that area, officials have signaled that they plan to keep raising rates to between 5 and 5.5% throughout the rest of this year, and keeping it kind of there. Do you foresee that being the case? Should we expect an increase? I know that they're saying they're not going to waver. What do you expect, looking at your expertise?
Well, you find out that everybody has a plan until the first shot is fired, kind of thing. And the Federal Reserve has to be able to lend stability to the market and say things that are a little bit predictive, or in terms of forecasting, okay, here's what we think. But we receive economic information every week, and the economic information that we receive may change the Federal Reserve's mind. So they have to show stability, but they have to show flexibility at the same time to adapt to the current environment. Right. We started 2020 with everyone thinking, all the experts thinking, rates are going to creep higher, and business will be as usual, and the housing market's going to do whatever. Nobody, of course, saw the pandemic hit, the impact of that on the housing market, the impact of that on the rate environment, the severity of what was going on there. And so the whole industry, the whole nation, the whole world had to change based on that. So all the predictions that were in the early part of 2020, flew out the window. They were worthless. 2022 started, and people thought rates would kind of creep up, and they thought this, and inflation was starting to be a problem. And then all of a sudden, Russia invades Ukraine. So we had to be able to adapt to those things. Now we enter 2023, and we start to move through 2023. Right. Nobody's predicting another pandemic. Nobody's predicting another, invasion. Right. There are signs out there that China might do something. I mean, there's always kind of things going on out there in the world. Nobody has a crystal ball, though. And so the ability for interest rates to change based on world news and US news is very, very important. Right now, as we're taping this, rates have been relatively stable. They've been creeping down a little bit here as we begin 2023. It's nice to see. People are talking about a recession, but people have been talking about a recession for months and months and months and months and months. And the employment picture is good. Personal income and consumption are decent. The housing market, you see these headlines about housing crashing. I don't see housing crashing. I see, we don't have the same ability, I think, to have housing appreciate 20% a year for the last couple of years. We have to come off that pace to be healthy. So I see appreciation slowing down, which is fine. But in certain markets, it's still very, very solid. At the higher end of the price levels, San Francisco or Manhattan, there's some weakness, but in places like Yuma, Arizona, or Omaha, Nebraska, I think the market is still pretty good. And so we're dealing with these things. So right now, actually, the inflation data that we've been receiving has been good. It's showing that the Federal Reserve is having an impact, and it's showing that, we're in an okay place. So rates are where they are. And I think people will become accustomed to interest rates where they are and carry on business. Nobody's out there basing the future of their company based on somebody's interest rate predictions. At least I hope not.
Right.
And so they tend to be more focused on service and programs and let rates do what they may. And right now rates are pretty stable.